Hello and welcome. Thank you so much for joining us today. My name is Sarah Zabo. I'm the Director of Plain Giving here at Swedish Foundation. The foundation is the fundraising arm of Providence Swedish, the largest nonprofit healthcare system in Washington State based in Seattle. I would like to take an opportunity to thank our donors who are joining us today. Without your support, we can't continue the innovative work we do every day for our patients. This is the second of our two-part estate planning series. We hope you were able to join us on Tuesday for our first session on estate planning basics, but do not worry if you couldn't. We will be sending out recordings to everyone actually, whether you were there or not. So you'll be able to catch up. If you have any issues hearing the audio, please dial 253-205-0468 on your phone, and the webinar ID is 867-8190-4284. And if you're having any issues with viewing, hearing the call, you're not able to resolve, please email us at foundationevents@swedish.org and we'll try to resolve your issue. And we're going to pop all that information in the chat so you can see it if something happens later. This is also being recorded, as I said, and you'll be able to view it later. So it'll go out in a follow-up email that you'll get. So if you have to jump off early, do not worry. You'll be able to watch the entire thing. This presentation will be an hour long with 30 minutes of questions. You can ask questions during the presentation. Just put them into the Q&A, which is in the bottom kind of right of your screen, right next to the share. The chat feature is disabled. So we can post things in the chat, you cannot, but I will see your question. I will ask your question for you. So you can get your question out there. And I promise you, if you have a question, someone else has the same question. So please do not feel shy about asking. Sharon is lovely and would love to answer your questions. Okay, now that we have completed our virtual housekeeping, I am delighted to introduce our speaker today, Sharon Perlin, the Senior Vice President and Client Advisor in Whittier Trust Seattle and Portland offices. Sharon works closely with clients to understand their priorities, goals, and philosophy with respect to stewardship of their wealth, as well as their personal circumstance and family situation. Her goal is to maintain and nurture the human element of wealth management. Sharon's advice around planning always reflects clients' articulated values with an eye to tax mitigation. Thank you so much for being here today, Sharon. Take it away.
Good morning, everybody, or good evening, excuse me. Been that kind of a day. Thank you so much for that beautiful introduction. I'm very happy to be here today. Thank you to Sarah and the whole group over at Swedish Foundation for inviting me. We're going to be talking about trust planning basics today. I'm sure everybody's heard of a trust, and you've heard it in lots of different contexts. In starting this presentation, I honestly just looked up in the dictionary, what is the definition of a trust? What is a trust? And this is what the Webster Dictionary defines as trust as. A trust is a relationship in which the holder of property gives it to another person or entity who must keep it and use it solely for the benefit of a beneficiary or beneficiaries. That's it. Simple. We're done with the presentation. No, you're not so lucky. So let's talk about a trust and why one might use a trust. I get this question all the time. Sharon, should I use a trust? Should I use a will? What's the right planning tool? So basically, there are a number of ways to give your testamentary intentions. Testamentary intentions are what you intend to do upon your passing with your estate. You can operate under a will. A will is something you draft in your lifetime. It can be changed at any time, and it becomes a legally enforceable document upon your passing. Or you can use a trust, and that's what we're here to talk about today. And a trust is a document you write in your lifetime. You can make changes throughout your lifetime. It becomes irrevocable, not changeable upon your passing. Let's talk about the reasons one might choose to use a trust. I kind of put this in a few different reasons. First and foremost is to avoid probate, and we're going to delve into each of these. Secondly, to protect beneficiaries, to set parameters for tax planning purposes, and to leave a legacy. Now, these are my ideas of why one might use a trust. I'm sure if you talk to anyone in the business, they'd have their own list, but this is how I thought of structuring the conversation about why a trust. So let's delve into each of these areas. Okay, Avoid probate. I hear this all the time. Shouldn't I use a trust, Sharon? I want to avoid probate. Probate laws differ state by state. In many states, you definitely want to avoid a probate. They're onerous, they're expensive, they take a long time, they're clunky. That is not necessarily the case in Washington. A lot of folks in California, they come to Washington and think it's got to be a trust over a will. That's because in California, you definitely want to operate under a trust. In Washington State, it really is, you can go with either option. So let's first talk about avoiding probate. Probate is the process where you actually go to court and you open up an estate. When you operate under a will, you go through this process in court by opening a probate. If you're operating under a trust, there's no need to open a probate. There's no need to involve a court. So you don't have any costs when the person passes away. You'll have the cost of if you're hiring an attorney to help you interpret the trust provisions, but there's no going to court and open a probate. So you're not paying the fees for a probate, and you're not paying attorney fees. Now, just to put it in perspective, I haven't opened a probate in years, but last I opened a probate, the cost was about $360 in terms of court fees. So we're not talking about tremendous fees, but it is something to consider. The other issue with a probate is time. When you open a probate, there are statutes around when one can begin to close an estate. So when you file a probate, you have to wait 3 months at the least before you can start even thinking of wrapping things up. So there's just a time element that doesn't exist when you're operating under a trust. There's also the issue of privacy. When you're submitting court documents are public record. You can go into in King County, the King County Clerk's office, and you can look at documents that have been filed in the opening of probate. Now, you can redact documents, and there's certain things that aren't for public viewing. But if you're concerned with privacy, again, you might want to avoid the probate process and operate under a trust. Again, state laws differ, but in Washington state, in terms of cost and clunkiness, it's okay to go through the probate process. But if you're concerned with one of these issues here, you probably want to consider the trust over the will.
We have a very quick question, Sharon.
Sure, go for it.
The question is, what if your children are in California and not in Washington? So you're in Washington, but your beneficiaries, your children, are in California.
So it's in this case, it's the decedent. It's the residency of the decedent really is the operable information here. So if your kids being beneficiaries in California don't make any difference for you being domiciled in Washington. Great question, but it's really about where the person whose testamentary document we're talking about, where is their state of residency. The beneficiary's residency doesn't matter unless the beneficiaries live in a state that have any kind of inheritance tax, and California is not that. The only state I know of that has any kind of tax on inheritance is Pennsylvania. I'm sure there's others out there. That's the only one I've come across. But really, the residency of beneficiaries shouldn't be a factor. Great question.
Perfect. Thanks, Sharon.
Yeah. So another reason to use a trust would be to potentially protect beneficiaries. So for example, if you say, okay, you're a married couple and you say, when I die, I leave everything to my spouse, then the first spouse dies, the second spouse has those funds, and the second spouse now can do what they want with those funds. So they could leave it to the children if there's children, or if they get remarried, they can leave all those assets to the new spouse. And the assets are not protected for the children. So many married couples will set up a situation where when you pass away, you leave all your assets in trust for the surviving spouse. The surviving spouse has use of those funds. They can serve as trustee. We'll talk about what the vocabulary is around all these issues, but that way the assets are protected. So when the spouse passes away, the assets go where the original testator determined the assets should go. So it's a way to protect assets, to know that they'll go where you want them to go. And that way ensures the estate passes on to descendants. Now, again, in Washington is what's considered a community property state. I don't know if people have heard this vocabulary of community property and separate property, but in Washington state, from the moment you get married, anything that's brought into the marriage, as in wages, retirement savings, is considered um, an asset of the marital community, not just the one individual. Also, any debt you bring into the marriage is considered owned by the couple. Anything you owned beforehand, you can maintain as separate, and any inheritance or gift an individual receives, if you're married in a community property estate, can be separate. But in terms of community property, when you pass away, kind of the estate divides. Here's your half, here's your spouse's half. So when I'm talking about maintaining assets for a surviving spouse, it's the assets of the spouse that dies first, that then instead of going directly over here to the other spouse, can go into a trust for this spouse. So that's kind of the what it looks like. So this is a use of a trust, is to protect assets for the next generation. The other reason to use a trust is when you're writing a trust, you're working with your attorney, you can decide the parameters of the trust. All of us have different situations, and there's different parameters that might make sense for you in determining where your assets will go. So one of the things you can put into a trust is age attainment. So I'm trying to think about the provisions. I have 3 children, and I believe my trust says for my kids, when I leave, if I pass away, my husband passes away, everything goes into a trust for my kids. My kids then, at the age of 30, will get the first distribution free of trust. 1/3 of the trust will go to them free of trust. 2/3 stay in trust. Then at the age of 35, half goes out of trust. And at the age of 40, the trust terminates and everything goes to my child. Now, hopefully, when I pass away, my kids will be way past the age of 40 and they'll just get the assets free of trust. But I've set these age attainment parameters to give my kids time to grow and learn how to be financially responsible. So when you're setting up a trust, you might decide to have these different moments in time where assets leave the trust and go free of trust to your beneficiary. In many cases, you can also have your beneficiary serve as co-trustee with somebody else and then ultimately their own trustee. So again, if God forbid you pass away and you have beneficiaries who are still young, perhaps they're not ready to manage their own funds, you have a trustee. So I keep using my as an example. I think in my situation, I have my sister as trustee of my kids' trust. But when they reach a certain age, they can serve as co-trustee with her, kind of learn how to manage the assets, and then ultimately they can serve as their own trustee. Another thing that comes up a lot, and families don't really like to talk about this with their lawyer, but it's a really important thing to share when writing a trust document, is if there's any issues around addiction, you can put provisions into the trust that tell the trustee distributions will go to this beneficiary, my child, as long as they're not using or abusing. Put in provisions for knowing that funds are going to a child who is dealing with addiction issues, so the funds aren't going to fuel the addiction. This is a very painful thing to think through, but it can really make a difference. The last thing you want is a beneficiary who struggles with addiction to inherit a chunk of change, right? You want those assets protected for that person. That person suffers from an addiction issue. Similarly, with protecting spendthrifts, there's just some people who don't manage money well. And rather than leaving a big chunk of change to someone, perhaps you leave in a trust with provisions to protect those funds so they don't end up spending all the money. I was once serving as trustee for a trust for the child of a couple that passed away. The child was already in his 40s and he just had never managed funds before. He asked me for a distribution of $1.2 million to throw a party. I said no. But this is the kind of thing where if the money had been under his control, he would have blown $1 million on a party. I was protecting the funds for his future. And the other thing, the other parameter you can set in a trust is you can set kind of discretionary standards for when a trustee can distribute funds. So there's a kind of a standard called HEMS, health, education, maintenance, and support. So many times in a trust, the testator, the person writing the trust, will say the trustee can distribute funds for HEMS purposes. So if a beneficiary, God forbid, has to go to the hospital, medical emergency, the trustee knows that that's a provision for which you can distribute funds. Education, you can be very specific or very general. trustee, please distribute funds for any educational purpose. For business, to invest in businesses, you can have a whole list of reasons why a trustee might make distributions, and you can have limits on those distributions too. So these are all things that you can put into a trust that are very different than just here's the inheritance, free of any trust. Another great reason to use a trust is for tax planning purposes. So what this means is we have a certain amount of money one can give in your lifetime or upon your passing to a beneficiary without incurring a tax consequence. Right now, we have these historically high gift and estate tax exemptions. In the year 2025, each individual can give just under $14 million in their lifetime or upon their passing without incurring any tax. After, it's actually $13,990,000. Any dollar over that is then taxed at 40%. So there's ways to capture this exemption in trusts and make sure you're utilizing the full amount of the exemption. This very, very high exemption amount was part of the 2017 Tax Act, which is due to sunset at the end of 2025. So we don't know yet what the exemption will be next year in 2026. Given that this was a law passed under the first Trump administration, one can assume that Trump will probably extend these high exemptions or perhaps try to make them permanent. Very few people believe that at this point the exemption will go lower. Interestingly, past candidates have proposed much lower exemptions, but it doesn't look like that's going to be happening in the near term. Another reason to use a trust for tax planning purposes is really just to control the gifting. You can set up kind of different kind of gifts to people in a trust, and also in addition to this exemption of the estate exemption, there's also a generation skipping tax, which means if you are giving not to the generation below you, but the generation below that, so it's would be from a grandparent or a grandchild. If you think about it, there's like two transitions, right? So anything over the exemption would be taxed 40% to the first generation, 40% to the second generation. There's a way to set up trust that you avoid the first generation being taxed, and it goes directly to the second generation. So these are a little bit more sophisticated ways that trust can be helpful in terms of tax planning. Another reason to use a trust is really um, to give not only funds but a legacy around what your values are. So I work with quite a few clients who are entrepreneurs. They made their money because they had great ideas that became successful businesses, and they want to kind of give that, in addition to funds, you want to give the legacy of entrepreneurship to the next generation. So you can write into the trust document kind of encouragement for using funds for those purposes. I work with a lot of people who made their wealth through real estate. They really want to encourage their beneficiaries to use funds to purchase real estate. So these are things you can write into the trust. So in addition to the HEM standard that I discussed, so telling a trustee that you can distribute funds for purposes of health, education, maintenance, and support, you might want to say, and also for purchase of real estate, and also for well-conceived business purpose. And travel. I have a lot of clients who really think travel is the way to learn about the world, learn about yourself, and they put in provisions into the trust to encourage beneficiaries to take funds to travel. And for any other purpose you can imagine. So that's the beauty of writing the trust. You really can it's not just about here, I want to give these funds to my next generation, but for what purpose? Here's how I would love for you to use the funds.
I have a quick question, Sharon.
You
Someone is
got it.
saying, as we're maybe crafting this trust document, are there things that they should consider if they might end up moving to another state or even another country? Or do we have to kind of redo if we make big moves like that? What have you advised your clients?
Great question. So one of the aspects you have to write in a trust is what the governing law of that trust is. So in Washington State, you're going to hire a Washington attorney to draft your trust, and it's going to be Washington law is going to be the law that governs the provisions of the trust. So just in terms, if your assets are in Washington and you're domiciled in Washington, you're going to have a Washington trust. If you move, you don't have to necessarily change, but just in terms of convenience, it makes sense to have an attorney where you're located to advise you around issues rather than hire someone back in Washington State because you have a Washington document. So depending on the trust, and the provisions, and we're going to get into this in a sec, whether it's revocable or irrevocable, I always recommend having the trust documents and any testamentary documents reflect the state and be under the laws of the state in which you're living. So great question. Now, if you have a job that has you moving around constantly, I wouldn't say you have to constantly change your documents. But if you're making a permanent move, I would consider just, you don't have to change the whole document. You can just update the governing law provision. So it's called doing a trust amendment. You do an amendment to the trust. All the other provisions stay the same, but now I'm operating under the state law in the state in which I reside. Let's talk about, there's so many different kinds of trusts out there. I can't go into every kind of trust, but I'm going to just use a little, just kind of clarify some vocabulary as we go forward and talk a bit about these different kinds of trusts. So first of all, there's 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 so many basic categories we can talk about, but inter vivos versus testamentary basically means inter vivos means in your lifetime, and testamentary means upon your passing. So you can draft a trust right now, an inter vivos trust. It would be a revocable living trust, of Sharon Perlin, let's say, and you can move all your assets into the trust right now. So I would redeed my house. Now the house is not owned by Sharon Perlin, but it's owned by the trust for Sharon Perlin. I can retitle all my checking accounts, all my assets, and now I have an inter vivos revocable living trust that's in effect right now. A testamentary trust is a trust that's written into a will. So many people will have a will, but the will designate a trust. So you're opening a probate, as we discussed, because now you're operating on a will. You open the probate, the court appoints an executor, which is the person who's appointed in your will. But then let's say the will says, I want to leave everything in trust to my children. So that trust that's written into the will is a testamentary trust because it only comes into creation upon the passing of somebody. So those are kind of just two different vocabulary words. Revocable versus irrevocable. This is very, very important. Revocable means changeable. So any trust that you write in your lifetime, during your lifetime, you can make it revocable and changeable. Irrevocable means you cannot change the terms. So upon your passing, a revocable trust will become irrevocable. But even in your lifetime, you can create an irrevocable trust. There are many reasons to do that. The most obvious reason would be to capture that gift exemption. So let's say you are, like I said, the gift, you can give up to 14 million tax-free right now. Let's say you have just a $20 million estate. And we know that, like I said, that high exemption of 14 million, that's based on a law that might change. But right now it's 14 million. So you want to capture that 14 million. You want to gift that 14 million now. So you can create an irrevocable trust. Now you take 14 million out of your estate, you put it into a trust. It's now irrevocably out of your estate. So your estate now is worth, remember we said you were worth 20 million? Well, now you're worth 6 because you gave 14 away. When you pass away and you give away that 6 million, depending on where the exemption is, you may have to pay 40%. Your estate might pay 40% on the remainder, depending on where that exemption amount goes in the future. But that'd be a reason to, in your lifetime, create an irrevocable trust now, because it takes those assets out of your estate for estate tax purposes. Exempt versus non-exempt. This is this is what we're talking about, the tax. An exempt trust is exempt from estate tax. A non-exempt trust has to pay estate tax. So in that example I just gave, 14 million came out tax-free, uses up the exemption, you have 6 million left. Now you pass away and you have 6 million maybe that you're leaving into a different trust. That trust is a non-exempt trust. It's not exempt from taxes. Grantor trusts are really interesting. Grantor trusts are trusts that you create in which the grantor is the person who's giving the funds into the trust, continues to pay any kind of tax liability on that trust. So you can set up an irrevocable trust for your kids in your lifetime to take advantage of some of that exemption. But as a way to continue to gift without using up more gift exemption, you can pay all the taxes on that trust. And so your beneficiaries are not burdened with the taxes. So it's a tax planning technique to gift without impacting the exemption by paying all the taxes on a trust. Charitable trusts are a whole other category that we'll talk about, where you can set up trusts that benefit both beneficiaries and a charity, a recognized charity. We have some slides on that we'll get to in a moment. Special needs trusts are trusts that are set up specifically for beneficiaries who are recipients of government benefits to not render the beneficiary ineligible to receive those government benefits. So if you have a child with special needs, let's say a child who then becomes an adult that's on some sort of government disability, SSI, SSDI, and there's certain income restrictions to be able to keep those government benefits, you can set up funds in a special needs trust. It's got very specific tax language that allows the beneficiary to still receive government benefits, but certain items can be supplemented in their life through the special needs trust. These are trusts that are you really need to find attorneys who know special needs trust to advise you on this, because it's that intersection between government benefits, tax planning, and trusts. This is just a one. I hear a lot people talk about slats, so I thought I'd let you know what a slat is. A slat is a spousal lifetime access trust. Slats are a way that you can take advantage of exemptions, but keep cash flow by gifting to your spouse. So in a case like this, let's say, again, you have a $20 million estate, so you're taxable, right? Because you're over that 14 million. You want to take some money out to reduce the size of your estate, but you don't want to get rid of your money by giving it to someone else, because you still want some cash flow for the marital community. You create a trust for your spouse. So you're not the beneficiary, but the spouse is, and the spouse can take distributions from that. It's a great way to take advantage of the exemption, move assets out of your state. So your state is smaller for estate tax purposes, but keep funds within the marital community. The only issue with this, well, there's a few issues, but one of the issues is if you do get divorced, you're out of luck. That money went to your spouse already. You can't get it back. They're irrevocable. But a lot of times I hear people ask me, I've heard of a slat, Sharon. What is that? That's what a slat is. The other kind of trust I hear people talk about and maybe know or don't know what it is a QPERT, Qualified Personal Residence Trust. For many of us, especially if you live in Seattle and you're lucky enough to own a home, our largest asset is our house, right? I bought my house. I bought my house for under $300,000. I don't even know what it's worth now. So one way to maybe gift to children or to take advantage of that exemption is to put your house in a trust, but have a period of time in which you're still able to live in that house. And after the term of the trust, the house then goes to beneficiaries. I don't recommend younger people doing this because because I've seen scenarios where people do this, the term ends and the kids say, sorry, mom and dad, you're out of the house. It belongs to us now. So you got to make sure it's the right mechanism before you start using a QPERT. There are many, many, many kind of trusts. I just wanted to throw out some examples of kind of specialized trusts and what the purposes are for using certain kinds of trusts.
Sharon, would it be fair to say that if you have an idea about a trust and you were to go to a trust agent, that they would know all these different trusts and could probably find the right trust for you?
Absolutely. I mean, really, this is the great question. There's so many techniques out there. There's so many different kinds of trust vehicles that it's so important to really talk to your attorney, explain all the people in your family, explain what you're trying to accomplish, explain what maybe you're motivated less by giving and more by taxes, whatever it is. Most trust and estates attorneys will be able to answer questions about any of these trusts that I've mentioned, and many more. So let me just move to some vocabulary, because I always hear people throwing around words like executor, trustee, trustor, settler, and like what do these actually mean? So let's do a little vocabulary lesson here. So when you're drafting a trust, these are the basic elements of a trust. The first thing is it's like the person who is creating the trust and moving assets into the trust. I've heard the term grantor trustor and settlor, they're all pretty much synonymous. This is the person who says, okay, I have these assets and I'm now putting them into the trust. They're not mine anymore. They belong to the trust. Goodbye. And like I said, remember I said that there was that grantor trust. The grantor gives the assets goodbye, but then maintains the rights to pay the taxes on it. That's when we see the term grantor used. But I've seen grantor, trustor, settler. All of these is the person kind of putting their assets into the trust. When you put assets into the trust, one of the main things you need to do is designate a trustee. A trustee is the individual, individuals, or corporate entity or fiduciary that will carry out the provisions of the trust and also hold liability to the beneficiaries. So we will talk about how to determine what the appropriate trustee might be, but I just wanted to make sure you understood what a trustee means. So like I said, for my kids, I think my sister is the trustee for my kids up to a certain age. But my job, what I do for Whittier Trust is when clients appoint Whittier as trustee of a trust, that's me. I work for Whittier Trust and I will serve in that capacity as trustee. So in many cases, it would make sense to appoint someone outside the family and or a corporate trustee. And we'll talk about that in a moment. The next vocabulary word, very important, is the beneficiary. Who gets the assets in this trust? You've written this beautiful trust. You're the grantor, settler, trustor. You've decided who your trustee is. Now, who benefits from the trust? Beneficiaries can be individuals. They can be other trusts. They can be charities. So you can have a trust that leaves funds to a trust, to a special needs trust, to a spendthrift trust, to a SLAT. You can have the beneficiary be another trust. It can be a person or it can be a charity. Once you've written this trust and you figured out who your trustee is, you figure out your beneficiaries, you then have to decide what assets are funding the trust. Now, if you're using the trust as your testamentary document, what most attorneys will do is, in addition to drafting your trust, they'll draft what's called a pour-over will. It's a very simple will that says when I pass away, if there's any asset that's still in my name, it pours over into the trust, because you want the trust to be the vehicle that determines where your assets go. But if you're writing a trust in your lifetime, you can decide right now, do I want all the assets in the trust? Or is this trust just for a particular asset, like just my house, or just my buildings that I own, or just my investment portfolio? So you have to decide what assets you're using to fund the trust. And then you have to retitle those assets into the trust. I can't tell you how many times I've seen trusts, beautifully written trusts, but they're empty. Here, the attorney wrote the trust, they gave it to you, but nobody actually titled assets into the trust. So it's important to remember that's the next step after you draft the trust, is to determine what assets you want in the trust and to make sure they are transferred or assigned into the trust. And then the other aspect of the trust that's very important is, like we said, the distribution provisions. So that is, when can a trustee distribute funds to a beneficiary? Under what circumstances? And this is the part that's just, you can't write in every possible life circumstance into a trust, right? You have to make general provisions, and the trustee has to interpret those provisions and hope that they're acting in the way that the grantor, settler, trustor would have wanted. Sometimes it's hard to do as a trustee, especially if you didn't know the person who wrote the trust, what their values were, what their intentions were. That's why I really, really like working with families over a long period of time, really understanding how they flow, understanding the values, understanding the legacy, so then if I am serving as trustee, I can honor what I believe would have been their intentions. And again, distribution provisions, remember HEMS, health, education, maintenance, and support. If you're writing a trust and you have no idea what you want your distribution provisions to be, that's the standard HEMS. The last thing I wanted to mention that you'll often find in trust is what's called the power of appointment. What this means is when you set up a trust for a beneficiary, Do you want to give that beneficiary any kind of power to decide where remaining assets will go once they pass away? So you can set up a trust that just says, hey, when the beneficiary passes away, it goes to the next generation, the next generation. You have the ability when you draft a trust to decide those provisions, but you can also give your beneficiary a general or limited power of appointment. And what that usually means is um, the trust will say, my beneficiary has a limited power of appointment to appoint assets to their descendants. If they don't use, uh, use this power of appointment, then I say everything goes to the next generation. You can say, you should always say where assets go in case your beneficiary does not utilize the power of appointment, but it's okay if you want to allow your beneficiary to decide where remaining assets will go. And that's something your attorney will talk to you about.
So we have one question, Sharon.
Yeah.
With all the stuff you talked about with trusts, if you are not legally married in Washington state, does that change anything of what you have talked about or how a trust? I mean, there's simply ones you probably couldn't do, like a slat if you're not legally married.
Right.
But are there any other elements of trust that would be different if you are maybe in a long-term partnership and you are not married?
So, um, so it's a great question. The beauty of a trust is you decide where it goes. If you're not married, then all your assets are your own, right? So you're determining where your entire estate is going. If you are married, and we talked about community property, then when the first spouse dies, there's kind of this separation of the estate 50-50, and you have to sit down and decide what constitutes 50-50. So if, let's say, you own a house, you and your spouse, does 50% of the house go into this estate and 50% in this estate? So the house now is owned by two entities. It's a little bit more complicated. When you're not married, you don't have to make that split. So all your assets are your own to determine where they go. In Washington State, the last I practiced, unless this has changed and someone tell me if I'm wrong, Washington State does not recognize meretricious relationships, meaning there's no protections for a long-term partner unless you're married. When you're married, there are protections that your spouse has. You can't, there's certain assets that are considered marital property that you can't then give to somebody else without the spouse's approval. Like, let's say you have an IRA, right? And you're married and you've been putting money into your IRA throughout your marriage. Well, half that IRA technically was funded with funds that are part your spouse's. So if you have a beneficiary other than your spouse has to sign off that they're okay with that. So there's protections that spouses have in community property states. You don't have to worry about those issues if you're single. Now, if you are single, but if you're not married, but you have a long-term partner, it's very, very important to have a trust to be able to leave assets to that long-term partner. Otherwise, they don't get anything. There is a law, every state has what's called an intestate statute. So in Washington State, there's a law that actually determines where your assets go if you die without a testamentary document. So if you pass away, and you don't have a will and you don't have a trust, the state says, okay, are you married first and foremost? Because if you're married, obviously the spouse has rights. Then it says, okay, married, let's say you're not married. Do you have kids? Okay, you don't have kids. Do you have parents? Okay, you don't have parents. Do you have siblings? Okay, you don't have siblings. Do you have cousins? So the state, based on this intestate statute, there is this kind of, waterfall of where assets will go. One of my first contested matters was so sad. This was before we had we recognized same-sex marriages, and this was a long-term couple. They had been together for 30 years, but they were two men. They hadn't married, and one of them passed away without a testamentary document. So the partner of 30 years got nothing. There was no protections. And since the state didn't recognize a spouse, and there were no kids, and there were no parents, and there were no siblings, like first and second and third cousins got the estate. People who didn't even know this person got all the money, and the partner of 30 years got nothing. So it's very, very important if you're not married, but you want to leave assets to a partner to have a testamentary document. Otherwise, that person has no protection. It's a great question. Thank you for asking that. Okay. Oh, I guess I had slides for all these things. So we talked about grantor, trustor, or settler. I think everyone understands what that means. Let me just talk just a second here about um, the trustee. So when you appoint a trustee, you can appoint one trustee or co-trustees. So you can have two people, three people serve as trustee. That's a little clunky if you have more than two, because then everybody has to agree and sign documents. And that can, like, if a beneficiary asks for a distribution, you have all these people have to decide and agree whether to give the distribution. So you don't want to have more than two co-trustees. Always important to designate a successor trustee. So that's if your trustee decides, hey, I don't want to do this anymore, or your trustee passes away or loses capacity, you want to know who the next trustee is. So for many people, if you're going to operate not under a will, but under a revocable living trust, you're going to have yourself as your own trustee, most likely. You might as well. But then when you pass away, who is your successor trustee? Who's actually going to carry out the wishes of your trust? And then sometimes, I don't ever use trust protectors, but sometimes you can also have designate what's called a trust protector and give this person specific powers. So maybe you give the trust protector the power to determine who the successor trustee is. If you're worried that if you don't want to designate a successor trustee, or you're worried that things might change in your life, you can also have a trust protector involved in certain decisions. So that's really, again, I didn't utilize those in my documents, but some attorneys think it's good to have yet another person in there with some responsibility, um, in addition to the trustee. Let me talk for a second about why you might want to use a corporate trustee, since that's what I do for a living. And I have found it's funny, when I was drafting trusts, back when I practiced for 15 years as a trust and estates attorney, and now I moved into the space where I actually serve as a trustee. So I've kind of seen both sides of the of trust, the drafting piece and the like implementing piece. And just sometimes it makes sense to have a corporate trustee and not a family member or a person. And here's why. First of all, corporate trustees don't lose capacity, right? God forbid something happens to me, there's someone else in my company that will step in, right? So it's a corporation. There's always going to be somebody there who can act in that capacity as trustee. Corporate trustees don't age out and die, right? This is why you have successor trustees, because if you're a trustee and you age out, you pass away, you need another trustee. We have trusts that have been in existence for 7 generations. And it's this, you have a corporate trustee. So it's the same corporate trustee who's been able to manage the trust. Now, 7 generations of a family are able to enjoy the assets of the trust. The other thing is, the truth is like, if there's a lot of laws and rules around trustee responsibility, liability, and trust interpretation, I wouldn't want to do this if I didn't understand trust laws. I think it's a lot to put on a family member to understand how to interpret provisions of a trust. Now, again, it depends on your situation. If in my situation, my sister knows everything about my life. I totally trust her. She's more responsible than I am. She makes sense to serve as a trustee for my children in that way. But, if I had the kind of funds that could allow for multi-generational wealth, like these families I'm talking about with 7 generations of wealth, I think I'd want someone to serve as trustee who had a little bit more knowledge of trust law and liability. Liability is like the number one thing too. If you serve as trustee, you can be sued, right? You're liable to the next generation. So if you have a trust that has, let's say, a lot of times there's in second and third marriages, there's trusts that go to the current spouse. And then when that spouse passes away, to the children. If the trustee is giving funds to this that second spouse, and then there's nothing left for the kids at the end. So many times I see these lawsuits where kids then sue the trustee. Why did you give away all the assets? So the trustee holds a lot of liability. So that's a big burden to put on a family member, because they can be sued by beneficiaries. And if you don't understand how to interpret trust provisions, you could get sued. You could make mistakes, right, and get sued. So you want to always put that on a family member. Um, and the last, and also I would say, in addition to the liability piece, probably the most important piece is preserving healthy family dynamics. I mean, think about this. If you have like siblings serving as trustees for each other, let's say a sister is trustee for a sister, you have to go ask your sister for funds. I mean, that could create a little bit of tension in your relationship. I've seen a lot of times where trusts are set up with the best of intentions, keep it within the family, but it ends up just destroying the family because of the tension around making these decisions. It's a lot to burden in relationships in a family. I have a lot of horror stories. I won't go into them, but brother suing father, sister suing brother. It's really ugly. Again, I don't want to freak you out. Maybe in your family it's appropriate to use a family member, but this would be a reason to choose a corporate trustee over a family.
And I think the other thing, Sharon, that we talked about a little bit with on Tuesday was they are great options for successor trustees, like you said, so that if a family member maybe gets into that situation where they say, this is ruining my family dynamic, I do not want to do this anymore, there's another option for them so they can say, I'm done, and someone else can step in and support. So leave options available for your
Absolutely.
beloved family members if they are, even if they're willing to take this
Yeah.
up.
I mean, when that's how I got appointed twice now as trustee because families fought and they just said enough already. Let's get a corporate trustee in there. So yeah, keep your options open. Okay, we talked about how beneficiaries can be different individuals, trusts, or charities. Um, Again, assets to fund a trust, cash. Obviously, you don't have to retitle cash, securities. So if you have an investment portfolio, rather than being like the Sharon Perlin brokerage account, it'd be the Sharon Perlin Trust brokerage account. Business interests are also, I have a lot of trusts that hold privately held like shares in companies, also LLC interests. These you move into a trust through what's called an assignment. So you have your attorney draft an assignment that says, this LLC interest is now an asset of this trust. So you do have to engage in attorneys for some assets to move them into the trust. I've had real estate would be by title, right? Like if I had my house, rather than being Sharon Perlin, it would be owned by the Sharon Perlin Trust. And if you own the house, you can sign over your deed to your trust. And especially if you're the trustee, it's really not a big deal. If you're the trustee of your own trust, you're not really giving up control of your house. I mentioned these miscellaneous assets because I've been trustee of trusts that had a whiskey collection. This was a guy who had, it's crazy, you guys. It was like a $1.5 million whiskey collection. And it was an asset of a trust. I've seen art being assets of a trust, vehicles, anything can be an asset of a trust. And one of the things that's when I talked about that tax planning technique that people do is if you're one of those people who's lucky enough to have a taxable estate, and let's say you have assets that are going to grow in value over time, you take the asset, let's say, I don't know, you own an apartment building that's worth $10 million, you put it into a trust. Now, over time, that asset's going to grow. Maybe now when you pass away, the asset's worth $30 million, but that $20 million of growth happened outside of your estate. So you only use 10 million of your lifetime gift and tax exemption right to move it into the trust. But now the assets worth 30 million, but it didn't change the size of your estate because for estate tax purposes. So again, a little bit more sophisticated, but definitely one of the ways to utilize the to tax plan is to move assets that you know that will appreciate over time into a trust and out of your estate. We talked a bit about distribution provisions that you write into a trust. So mandatory versus discretionary, this is really important. Mandatory means the trustee has to. So many trusts say the trustee shall or must distribute all income that a trust generates over the course of a year, but has discretion whether or not to dip into principal. So those are called mandatory income trusts. And so as trustee, we're collecting every month income. So through dividends or bond income, and those are being given out to beneficiaries on either a monthly, quarterly, annual basis. But then every once in a while, the beneficiary comes and says, hey, I don't have enough money for this house project. I'd like to request funds from the trust. And that's when the trustee has discretion and has to read and interpret the trust provisions to make sure that you can make that distribution. Again, we talked about HEMS and we talked about age attainment, having moments in the trust in which you distribute free of trust. So I just had a trust where it said at age 30, the beneficiary gets 1/3 of the trust principal. It was the most beautiful thing to do to call this beneficiary up wish her a happy birthday and let her know she was having, in this case, 1/3 of the trust was about $1 million transferred into her, to her free of trust. It's a nice thing to be able to tell somebody.
Sharon, we have a question.
Sure.
Um, do you have recommendations for people that say aren't going to meet that federal exemption threshold? They don't have 14 million. I know we do have a Washington estate tax that is
Yeah.
exemption that's much, much lower.
Yeah.
But because I know people utilize trusts at much lower um, amounts. Are there anything that, I mean, there are a lot of advantages you talked about, special circumstance, but like if someone comes to you less than 14 million, do you have general recommendations when it comes to trust?
Yeah, so it's a great question. Washington State has a state estate tax limit. So the federal is at 14 million, but Washington State it's 2.2 million per person. So 4.4 per couple. So absolutely same thing. You want to utilize the exemption. So it's such a great question. So let's say I'm just gonna let's make something up here. Let's say you have a couple worth $5 million in Washington State. Okay. So the first one dies, right? It's a community property state. So 2.5 here, 2.5 there. Let's say the will says, I leave everything to my spouse free of trust. So now this 2.5 goes over to this person. Now this person passes away. They have a $5 million estate. So 2.3 million of that is going to be taxed because it's over the 2.2 Washington State exemption. Now let's do this scenario. $5 million estate, each one's worth 2.5. First spouse passes away and says, I take the full amount of the exemption and put it into a trust for my spouse. So now you have 2.2 million that's in a trust. So only 300,000 goes over here. So now when this person passes away, they're worth 2.8. So only 500,000 is over the, excuse me, only is under the is over that 2.2 and will be taxed. So it's a very different scenario than tax it on the 5 million. So yes, even in Washington State, you want to leave that, you want to take advantage of that exemption, put it into a trust. Now let's say again, we have that 2.5 million, 2.2 goes into an exempt trust, remember exempt, and then that last 300,000, that can go directly to spouse, or you can also leave it in a trust, but that trust would be non-exempt, the non-exempt from taxes. So absolutely, you want to utilize a trust to capture the exemption. Does that make sense? Hopefully that answered the question.
Absolutely. And then there are just legitimately a lot of non-taxed reasons that people have living trusts and other trusts. So,
Absolutely. Again, to protect, again, I'm sure for those of you who have kids, every kid is different. They're all wonderful, right? But some struggle with different things. So maybe it doesn't make sense to just leave everything to your kids. Maybe it makes sense to put it in trust with some kind of guardrails to protect the funds so that they're for your kids for their lifetime. There's lots of reasons. Tax isn't the only one. I won't go any more into the PowerPoint. We talked about that. That's leaving your beneficiaries the options of deciding where the trust assets would go upon their passing. I really want to make sure we have time to talk for a moment about charitable trust because this is the way that many of our nonprofits, including the Swedish Foundation, can benefit from generosity of donors, while at the same time that donors can maintain some kind of cash flow. So there's two general types of trusts. Charitable trust, there's charitable remainder trust and charitable lead trust. And let me just kind of quickly go through these. So it's charitable remainder trust or irrevocable trust. So now you guys know the vocabulary, non-changeable, that provide for a payout to a non-charitable beneficiary for a term of years, and then the remainder goes to a charitable beneficiary. There's two. So what this means is that you take the money, you take it out of your estate irrevocably into a trust, but over the term of the trust, let's say it's a 20-year term, 15-year, 10 years, a beneficiary, you can still get a payout from this trust. You can set it up as a unit trust or as an annuity trust, CRUTs or CRATs. So a unit trust will pay out a percentage of that trust, let's say 4% every year to you. An annuity trust pays out the same amount. So let's say every year 100,000 goes to the trust to you. But at the end of the term of the trust, or when the beneficiary passes away, the assets go to the charity. So here's kind of a chart. You have the donor putting the funds into your irrevocable trust. Distributions are going out to a donor or to heirs, taxed as income. And then at the end of the term, the remainder balance goes to the charity. I'm assuming, Sarah, has worked with these and understands the value of these, again, you get the assets out of your estate for estate tax purposes. You still get some sort of cash flow to yourself or to a child or any beneficiary you want to designate. And in the end, a charity benefits. The things that are great about charitable remainder trust are they tax exempt. The payments can be fixed or variable. There's no capital gains tax upon the sale of the property. Um, there's more sophisticated tax planning around these. I would definitely encourage you to talk to both an attorney and a CPA if you're setting these up, but these are wonderful vehicles to consider. Here's another kind of shows you put, let's say in this case, it's a couple puts 10 million into a CRUT. They get 5% of the fair market value of that CRUT every year. And when they pass away, the remainder of what's left of that 10 million, presumably that 10 million has been invested over years and worth well more than 10 million upon the death of the spouses, then goes to Swedish Foundation. The charitable lead trusts are kind of opposite. So charitable lead trust is the payout goes to the charity for a term of years. And then after that term, the payout, the remainder will go to a beneficiary. So I'm kind of like show you how this would go. So in this case, you have money going into the charitable lead trust. You have funds going over the period of the trust to a Swedish Foundation. And at the end of the term, funds go to a beneficiary. And this, again, I'm not going to get into all the sophistication around the tax planning, but there's a tax benefit to setting this up. Finally, there's two other charitable vehicles that can be used for tax purposes in addition to these charitable trusts, donor advised funds, which I'm sure Sarah might, well, maybe Sarah's talked to you about, or private foundations. These are also ways to move assets out of your estate to reduce the size of your estate for estate tax purposes. And they're a great way to be charitable. I mean, I find that my clients, even though being philanthropic is a tax planning technique, for most people that I work with, it's also very much aligned with their values, and it benefits all the great nonprofits in our community, like the Swedish Foundation. So that was a lot. We're at 3 minutes to go. So I think I'm gonna stop right there. That's my email address. Feel free to email me if you have any follow-up questions. A lot of the stuff, it so depends on the size of your estate, your assets, if you're married, if you have kids, if you have grandkids, if you have the kind of funds to have multi-generational wealth, you're just trying to make it through the day. We're all in different circumstances, but all of us, the one thing that's for sure is one day we're all going to be off this earth, and we need to plan around that inevitable event. And it helps to have someone you trust to talk to. I really appreciate the time that Sarah and the Swedish Foundation folks gave me. I hope this has been helpful. And please let me know if you have any questions.
Yeah, so we are wrapping up our time together. We'll sit here to see if anyone else has any more questions they want to put in the Q&A before we let Sharon go. Um, and as I said before, we have this recording. You will be receiving this in addition to Estate Planning Basics. And you can always reach out to us at Swedish Foundation to make referrals to wonderful advisors like Sharon and Emma, who did Estate Planning Basics for us. Um, and they can really help you build the right plan for your family, which I hope is the big takeaway from today. We have someone saying, "Thank you so much. It was so helpful."
Yeah.
Um, so yeah, like as things goes on, if you have more questions, send them our way. We'll send them to advisors that can help you the most. And hopefully everyone can walk away from these 2 sessions knowing the kind of plan they might be interested in having. So, I just want to say one last thank you to our donors who make events like this possible, and just wishing you all a great rest of your evening. Thank you so much.